Let's talk about stocks right now. The Indonesian Stock Exchange has become one of the worst performers in Asia lately, amid high selling pressure on a number of blue chip stocks on the local stock market.
The Jakarta Composite Stock Price Index, or JCI, which recorded its all-time high at 7,435 on March 14th, has continued to decline recently, and it even fell below 6,800. On June 14th, the JCI fell further to 6,725, 10% lower than its highest level this year. Although the price index has begun to recover again last week, market remains volatile as the global economic situation is not showing any significant improvement. The decision of central banks of several large countries to maintain high interest rates has also partly contributed to the decline in share prices on the Indonesian Stock Exchange. Indonesia's stock prices keep falling despite good news on the country's economy. During the first quarter of this year, the Indonesian economy grew by 5.11% year-on-year, the highest growth in 3 quarters. It also surpasses the market growth consensus of 5%. In fact, in its latest report on Indonesia, the World Bank has raised Indonesia's gross domestic product, or GDP, growth forecast to an average of 5.1% per year from 2024 to 2026, up from the earlier projection of 4.9% for both 2024 and 2025, despite headwinds from a subsidizing commodity boom, increased volatility in food and energy prices, and rising geopolitical uncertainty. Market analysts believe that Federal Reserve's policy of again delaying lowering interest rates has contributed to the decline in shares in IDX. Many foreign investors sold their shares and shifted investments abroad after the Fed again postponed lowering interest rates. The delay in the interest rate cut has also contributed to the fall in the rupiah against the US dollar this month. The Indonesian rupiah hovered near 4-year lows on Wednesday, June 26, while other Asian currencies traded in the red as the Federal Reserve's higher for longer monetary policy stance pressured regional assets, Reuters reported. The Indonesian rupiah fell as much as 0.5% to 16,445 per dollar, hovering around its lowest level since April 2020 as a slew of domestic factors, in addition to U.S. monetary policy, continue to pressure the currency. Market analysts say that the implementation of the pull call actions for shares of companies put under a special monitoring board has also played a role in the sharp drop in share prices. Share prices of companies put in the special monitoring board in the middle of June, including Barito Renewables Energy, which has the largest market capitalization, fell sharply due to the implementation of FCA, causing a significant drop in the main price index. The Indonesian Stock Exchange finally decided to amend last week the rules related to the FCA measures, which have caused the stock market to plummet in recent weeks. It should become a lesson learned for the stock market operator that a misguided policy could be fatal for the market, especially if it is implemented amid uncertainties.
Now, the Indonesian stock market has been under intense selling pressure in recent weeks. And joining us today is Bapak Ahmad Mikail Zaini, or in short, Pak Mike, Chief Economist at Sucor Sekuritas, where he will share his insights on the reason behind the recent falls in share prices on the Indonesian stock market. Welcome, Pak Mike, to Economic Outlook. Thank you so much for being here the first time for you.
Yeah,
well, Pak Mike, the Indonesian share prices have declined sharply in recent weeks amid intense selling pressures from the foreign investors. Why is the Indonesian stock market performing so badly recently? What is the cause behind this?
Yeah, I think there are two factors determine the stock market performance recently. The first from the uncertainty on the external factor, which is the uncertainty on the Fed monetary policy prospect. Yeah. Previously, many economists globally expect that the Fed will cut the rate by 3 times this year. But unfortunately, the inflation in the US quite sticky, so the Fed hesitant to cut the rate by 3 times this year. So the Fed only give a clue recently to only cut the rate by once this year. So this create a havoc in the global financial market. So that's why many economists expect that the cost of borrowing fund will be much higher persistently in the long terms. So it is from the external factor. And then we also have the geopolitical tensions in the Middle East. In April, for the first time, Israel and Iran attack each other. So it creates also nervous for many investors. So they afraid that the commodity price will skyrocket again and then create another inflation wave. And in the domestic side, we have an uncertainty also after the elections in the first quarter. Investors still wait and see for who will be person in charge in economic ministry. So there are still uncertainty there, and also investors also quite nervous about the fiscal budget, the prospect of our fiscal budget of these new leaderships, whether the government deficit will increase to fulfill all the promises from his campaign. So I think both the external and internal factor quite determine the stock market movement for this year.
Okay, there are so many factors that you
Yeah.
explained just now, but in summary, you also mentioned that basically the two major factors is the uncertainty in the Fed as well as the geopolitical tension. Those are from the external factors. But speaking internally, our GDP growth so far is 5.1% in the first quarter, and this actually exceeds most of the economists' estimates. So with this GDP growth, why has this growth, this number, have not bring a positive impact into the local stock market to growing more confidence for our stock market?
Yeah, because many economists and analysts focus on the real GDP growth. What you mentioned is real GDP growth numbers, 5.1%. But for the stock market or other financial asset to grow, we need a liquidity or the growing on the liquidity. So there are two indicators to calculate or to determine the liquidity expansions. First is the nominal GDP growth. Unfortunately, our nominal GDP growth grow below our real GDP growth number. So our nominal GDP growth is only 4.8% in the first quarter. So below, quite low compared to average historical data. Yeah. For average, for the last 10 years, our nominal GDP can grow by 8% or 9%. So it means that the liquidity expansion is not enough to prompt up the financial asset like equity and bond market. So we have a problem in the liquidity expansions. The lack of the liquidity expansion come from the lower loan growth disbursements. Bank credit growth is only grow by about 7%, about 10% first quarter. This year is quite below compared for the last 5 years about 15%. And then many sectors have deflationary pressures. So basically, the liquidity expansion is not enough to prompt up the stock market.
So in summary, basically all these numbers are not piling up and not resulting in a confidence for investors.
Yes.
Okay. Well, the U.S. Central Bank's decision to delay the interest rate cut have also bring negative sentiment to our Indonesian market. Why is Indonesian stocks as well as the rupiah are very sensitive to the U.S. interest rate policy?
Yeah, because we are adapted a free capital movement, so local investor and foreign investor can easily move their money from Indonesia to another country which over higher returns in terms of the fixed asset returns. And then for the last 3 years, the Fed rising the policy rate by 550 basis points. Unfortunately, Bank Indonesia is only rising about 270 basis points, low compared to what the Fed did for the last 3 years. So what we offer is not enough to bring the capital back to the Indonesia. So although we enjoy 49 months trade surplus, means that our export is way above our import, but the export receipt is not parked in Indonesian banking system. So many exporters park their money in overseas banks because the overseas bank offer you with high deposit rates. So we cannot compete with them. So the money start to outflow to Indonesia, and then they depress the rupiah. So that's the problem. So that's why BI introduced a lot of instrument to attract more foreign investors to invest. But as long as the Fed do not cut the rate or does not cut the rate in the near future, I think the situation is still the same, yeah, until maybe the end of this year.
I see. That is one major factor, and the other being geopolitical tension that you mentioned earlier. And it seems like there will not be any big improvement towards the end of the year. If anything, people are expecting that it might even be gloomier forecasted until the end of the year. How do you think this will affect Indonesian stock market for the rest of the year? What is your forecast on this?
Yes, my forecast is I'm not quite gloom on these situations, yeah. As long as there are internal improvement in Indonesia, let's say the new leadership, Pak Prabowo, can bring a confidence to local investors, put good quality of person in economic sectors, in Ministry of Finance, for instance, and then many ministry that related to the economic activity. If this confidence improve, then I think people will start to buy this stock in Indonesia because the valuation is already cheap enough. And then if the let's say there are no escalations in the Middle East or in Ukraine for this context of geopolitical tensions, let's say the commodity price stay at this level, particularly for the oil price. If the oil price can stay around $80 per barrel, I think there is no quite negative effect for the Indonesian's economy because we import a lot for oil. So I think if the geopolitical tensions stay at this level and Indonesia can improve, the new leadership can bring the confidence. I think our stock market can improve in the second half.
And where are we looking at this improvement? Where are we expecting it to happen? When?
I think start from this month until the end of this year. So if the inflation in the US, let's say, can decline enough, then the Fed will cut the rate like his promise in the last meeting. So I think the BI will follow also, reduce the rate, and then push a lot of liquidity, flooring a lot of liquidity into the financial system. Then I think it will create, liquidity expansions domestically, and it will prompt up the stock market.
I see. Now, Pak Mike, the investment bank Morgan Stanley, it has recently downgraded Indonesian equities to underweight due to concern over the direction of the next government's fiscal policy. Now, do you think that this Morgan's downgrade will discourage foreign investors, yes or no? And can you elaborate more on this?
Yes, of course, because like I said before, foreign investors quite nervous for the fiscal deficit to grow, because to fulfill all the promises, this new government need a budget, additional budget, to finance like free lunch program.
Yes.
So it will create around 400 trillion, an additional about 400 trillion rupiah for the next 5 years. So if there is no additional increase from the fiscal deficit, they don't know how to finance this program. So basically, like I said before, this new government should bring the confidence. But I think it is not as easy as what many foreign banks predicted, because by law we cannot, pass on the 3% of deficit of GDP annually. So basically, the government should coordinate first with the legislative before they can pass on the threshold. So I think it's not quite easy. So for the next 2 or 3 years, I think the deficit is still manageable. So it is too much, I think, for stock market to correct it at this level. The rebound can be easily, I think, if this new government can give the confidence back.
So a lot of pressure in the new government
then.
Yes. All right, let's talk about one more aspect here, which is the full call auction, or in short, FCA. They have the full call auction for shares put under special monitoring board has also contributed to the sharp fall in our share prices. Why such a policy draws a negative reaction from the investors?
Yeah, because actually these new regulations make the liquidity dried up. So unfortunately for our stock market, the liquidity is not quite ample compared to our peers, like say in India and Malaysia, for instance. So with these full call options, new regulation, it dried up the liquidity because you cannot easily withdraw your money after you invest. So they lock up by an auctions every day. So it creates uncertainty on the liquidity side, as well as that many listed companies that included in the full call option list.
Yes.
Most of them is big caps names. So it creates pressures on the market capitalization as well as the liquidity in the system. So when you make a trouble on the liquidity side, I think it's easy for the local and foreign investor even to withdraw their money from the stock market. So the liquidity is the most important factor that the investors see before they want to invest in the stock market.
I see. Okay. And finally, based on your assessment, Pak Mike, what sectors or what industries at the Indonesian stock market do you think which will still give a good return in the at present?
I think banks, I think should be the most be prioritized by the investor recently, because the banking sector stock price already depreciated a lot, already declined a lot, and then it's quite cheap enough.
I see.
And I believe the prospect is quite positive, because the loan growth now start to expand after these elections, after the new leader inaugurated. I think the business sector start to borrow the money from the banks to expand their business. So the loan growth, I think, can achieve 13 or 14% this year. Adding, if the Fed cut the rate and the BI will follow, the net interest margin will, increase again. Both factor, I think, will benefit the banks. And after the banks, I think then another interest rate sensitive sectors like property, like automotive sectors, I think will also get the benefit from this.
Okay.
Yeah.
But first we need to get confidence into the market.
Yes.
Okay. All right. Bapak Ahmad Mikail Zaini, Chief Economist of Sucor Sekuritas. Thank you so much for coming to Economic Outlook, and we are looking forward to have you again.
Thank you.